So I received a letter, sales pitch from Fidelity today or yesterday, a little postcard that says they're zeroing in on value, And what they're telling us is that they're introducing the industry's first true zero expense index funds directly to investors. Value you'll only find at Fidelity. We're raising the bar on value by lowering the cost of investing. Our stock and bond index mutual funds now have lower expenses than comparable Vanguard funds. And we offer the industry's first true zero expense ratio index funds directly to investors. In fact, they give us this nice little handy dandy chart. They say zero expense index funds at Fidelity, yes. Vanguard, no. Let's see, zero minimum investment mutual funds at Fidelity, yes. Vanguard, no. Lower expense ratio on comparable stock and bond fund index mutual funds, Fidelity, yes. Vanguard, no. All right, so and then they get all the disclosures and all that. Look, I got no problem with Fidelity. They're okay company without question. I mean, they're one of the better guys for sure. My concern with that stuff, though, first, I never get a sales pitch from Vanguard because I need to. All right, and that's the issue. When you don't have to market, it means you can reduce your cost quite a bit, which thus Vanguard has is the cheapest game in town. Here's my concern with Fidelity. What's going on here? There's two things going on here. One is that Fidelity is losing market share as a custodian, and not as a custodian. Let me get around. There's two things going on. Fidelity is losing market share on their mutual funds and ETFs because what's happening is they are a huge custodian. They hold the assets in custody for their clients who are registered investment advisors and registered investment advisor reps, RIAs and IARs. Yes, and if you can follow that, good. You must have worked for the SEC because no one else can. But a registered investment advisor will use Fidelity to custody their accounts and basically keep record keeping, all that. That's a custodian. And what Fidelity can see is that Josh, as an RIA, and I don't manage money, so I don't do this, but Josh, as an RIA, will use Fidelity to hold the assets for my clients, but I'm going to use it and then invest in Vanguard. They know they can see this a mile away. So they say, look, we got all these RIAs that we use that use us for the custodian platform, but they're not using our funds. Well, what do we do to compete with Vanguard? Well, we got to undercut them somehow and give these marketing brochures to say, hey, look at us instead of Vanguard. Look, I got no problem with that. And I'm not even sure if they sent this to me because I'm an affluent zip code or if they sent this to me because I am an RIA, a registered investment advisor. I don't know. That actually just occurred to me. That might be kind of interesting to find out. I wonder if everyone else in my zip code received that same Fidelity thing because, again, we're in a pretty affluent zip code here in North Georgia. All right, so that's what they're trying to do. They're saying, look, we have all these people registered who are custodied their accounts through Fidelity, but they're using Vanguard. We got to nip that in the bud because we're losing assets big time. Now, you might say, yeah, but if they're offering zero funds, that doesn't raise the bar in terms of their fees they could generate. Yeah, sure it does, because what's happening is they can then offer other Fidelity products, almost like a loss leader. And I mean, look, I got no problem with that. Loss leaders work. I do a loss leader. When you sign up for my newsletter, I put my book out there for you to download as a PDF. That's a loss leader. So I have your contact information every now and again, probably a couple times a week. I'll send you an email. Theoretically, if I do another book, you might be inclined to buy it. You might want to hire me, blah, blah, blah. Loss leaders are a marketing tool that's been going around since the dawn of mankind. But that's number one. Number two, though, is what I don't like is that they're going to send these to people. Let's just say they send them to everybody in this neighborhood. And what happens, Fidelity has a pretty significant sales force. All right, they do. Absolutely. Vanguard does not. And so Fidelity will say, hey, we got you in the door. Let's call you up. Let's get you as an account owner here at Fidelity. That way, when you separate from service, you might roll your 401k or something like that. And that way we can sell you more expensive products. I can see that a mile away too. So you got two things going on is that they're trying to get the RIAs, the registered investment advisors, to not just custody with Fidelity, but to use Fidelity holdings. That way they can offer more holdings that are more expensive for the end client. And then two, they're trying to get individual investors to come in there and buy some of the funds. That way they have a chance to solicit them because you can't solicit unless there's an account there. And we know for a fact, do not call list does not apply if you have an account with a firm. I know that for a fact. So if you have an account with Fidelity, they can call you without question. Now you can turn them and say, don't ever do that again. And I think they have to follow that. But if you don't ever do that again, they can call you for sure if you have an account with them. That's no other way around that. But they can't just call me blindly, say, hey, Josh, we think you're the best. We'd love for you to be a client of ours. They can't. So they send these letters. I don't have a problem with that. But what I do have a problem with, all right, so if you look at the history of Fidelity comparing against Vanguard, Vanguard with John Bogle started the first index fund in 1973. John Bogle came from Wellington. He did his thesis in college. I think it was just his undergrad on indexing versus the money that's being lost because money managers. So Fidelity is owned by the Johnson family, a wealthy billion dollar family. Vanguard is literally owned by its investors. Literally, if you have a Vanguard fund, you own Vanguard. A little bit difference there. So Fidelity at the end of the day says back in the old days, oh man, we don't believe in indexing. Not just Fidelity, all the active managers. We don't believe in indexing. John Bogle's a fool, blah, blah, blah. What happened? Well, John Bogle won the day without question, Jack Bogle, because he said, you guys are wasting investors' money. But here's my concern and my issue with the investment industry as a whole. All right, what happens with all those fees you pay? Are you getting outsized returns? No. So if you're a net client, you're just a guy with $400,000 and you're paying somebody 1 to 2% a year to manage your money, let's just say $5,000 a year. Is that $5,000 a year generating you better returns or less risk, or is it not? And the answer is not. No other way around that. But what does the investment advisor who has you and plus a million other investors do with that money? Well, they can buy private planes. They can buy boats. They can have, wherever's it, Monte Carlo. I don't even know what those, the rich people go, Mackay or something like that. I don't know. They can have houses and beach houses and all this off your back. All right. That's a fact. In fact, I just talked to a guy the other day, and he's got, he has a firm that, let's just put it this way, the owner of the firm flies around on private planes all the time. And I just know that for a fact. And I sit there and I say, man, I want to know this guy. Hey, not my client guy, but the guy who's flying around private planes. Well, my middle-class investor is down 40% because the market's tanked. Are you going to give him a rebate by selling your private plane and say, hey, we screwed up and here's my private plane to realize that we didn't protect your assets the way we anticipated? No, you're still going to keep your private plane. And that's wrong. I mean, that's just wrong to me, that you're going to take an investor's money and turn around and use that to fly private planes. And that way you can go out there and solicit more and more people in which to do investments. That gives you more and more money, multi-level marketing, if you will. I find that frankly bad. I don't like it because they're not creating value. They're taking value from middle-class investors. That's a fact. There's no debate on this. Yes, I'll never work in the industry in this. I don't care. I'm never going to work in the industry doing investment management ever. They're taking value from middle-class investors. And instead what they're doing is, I just got a call there, sorry guys, is they're using it for their own wealth creation. And I find it disingenuous, if not even worse, because I say, hey, I want you to know, Grandpa and Grandma Jones, that when you invest with us, a part of your fees are going to go to pay for this guy to fly around a private plane. Are you okay with that? And Grandma Jones say, well, I'm okay with it if I'm getting a value for that. And then we show them the performance, and the performance is less than what you could have got on your own. And don't tell me you're getting better service. I just don't. So the fact that Fidelity is offering zero funds means I'm just telling you what it means is zero cost funds is that they are realizing the game on active management is over in terms of being able to charge a fee for mutual fund performance portfolios. What the fees are now is going to be registered investment advisors charging fees now. So the days of high cost mutual funds are going down, they're coming to an end. But that doesn't mean the days of high cost investing has come to an end either, because what has come to an end? What happens is you're still going to pay some guy to run your money for 1%. Now he's going to charge you 1%. That goes to him. Now the fees on the funds he's using will be down to 1/10 of 1%, which before was like 1% to the financial advisor, 1% on the mutual funds. So now the fees are cut. So they're saying, look, I'm cutting in half. Those days are going to come to an end too. And Fidelity's seen that. And that's why they're offering this zero base expense ratio mutual funds. So they see the game isn't charging a lot of money for active investment management. The game now is to get registered investment advisors to charge a fee for holistic portfolio advice. My friends, it's just not worth it. It's just not. At the end of the day, what you need financial planning advice. And you just go to Vanguard or you go to Fidelity on your own and just buy their index funds or Betterment or something like that and pay the 35 basis points if you want an active portfolio rebalancing solution. I got no problem with that. But the days of paying 1% are coming to an end, and I could not be happier. And I just think about the guy flying around that plane. I'll never forget. So I know this firm, and I had a client, he was Vietnam vet, Agent Orange, and he had about $300,000 in total, charging 2%. This firm was charging. And I'll never forget, I said, if the market tanks 40%, these guys are going to be bankrupt. And I knew that because I just knew. And I said, they're going to be bankrupt, and yet they're going to not get any money back, but this guy's still going to fly around his private plane. So essentially, this guy with Agent Orange from Vietnam and his wife, who that's all they had, because they're convinced to do a rollover from a pension. They should have kept a pension by somebody else. And they're going to do that rollover, charge 2% a year in assets under management. They're not going to be shielded from a market decline of 30 to 40%. And when that happens, they're doomed because they needed that money to live on for the rest of their life. And it breaks your heart. And that breaks your heart. But yet this guy's still going to be flying around private planes. It's not just this guy. I know other people in the business who do the same. They have condos, beach houses, the whole thing. It's sick. It really is. It doesn't have to be like that. It doesn't have to be like that. And so while I'm glad to see Fidelity charging low fees, I'm still despondent. We really am about how the industry as a whole is still taking money from you so they can live high on the hog. And I just hope that you don't pay that. I really, really do. I hope you say, no, I'm not going to pay you 1%. I'm not going to pay you more than 50 basis points all in. That's 1/2 of 1%. So you say your investment advisor, look, I'll pay you 50 basis points a year. So on, $500,000, that's still $2,500 a year. That ain't too shabby, my friends. But I'm not paying you 1% all in. I'm not. I'll pay you 50 basis points if you want, and you can buy some ETFs at 10 basis points. That's 67%. All right, so I just looked at my text. People text me like crazy all of a sudden. So look, I got no problem with that. 50 basis points, 10%, 1/10 of 1% on a mutual fund, on ETF. That's fine. But once you start going above 1%, that's just too much. There's just no other way around that. You're not gonna get ahead from that. Anyway, so that's my issue. I will lastly on this. I was working on a guy yesterday. I'm looking at his 401k, and he's got a mutual fund out there in his 401k as an index fund, but the index fund's charging 55 basis points. I'm like, this is crazy. You have an index fund in the 401k because it's all one company's investments that you offer. So there's one financial planning firm, investment firm, can say, oh, we offer index funds that are cheap. Well, that's not cheap. A 55 basis point, that's 1/2 of 1% expense on an index fund is just, that's ridiculous. But they get to say it so they can at least appease the regulators that, oh, we're not charging overwhelming fees. Yes, you are. If you're charging 1/2 of 1% on an index fund, that's just too much. It is absolutely too much. And if you looked at the performance, you can see it explicitly. The index is up 10. They're up 9.45. Why? Because they charge 1/2 of 1%, 55 basis points. So keep your eyes and ears peeled. Look for ways to reduce your investments. Fidelity's leading the charge in terms of recognizing what's going on here. If you're in high expense mutual funds or high expense ETFs or high expense across the board for your investment management, you're not getting value added. You're just not. So, all right, as always, if you like what you see, don't forget to subscribe. I hate to be all belligerent here. I frankly don't care. It's just my feeling and my gut. You don't have to agree with it. And if you're in the investment world, you probably don't agree. I get that. If you're not flying a private plane, you're like, I charge 1%. It's a fair price. Hey, man, as long as it's disclosed and your client knows what they're getting, I got no problem with that. But if you are flying around a private plane and you're charging your investments, your middle-class people 1% to 2%, I just find that wrong. And you shouldn't do it. All right, so don't forget to subscribe, comment, question. We'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.